Hello, and welcome to today's KraneShares webinar. Two sessions and revenge spending, China's Q1 market review. Hello, my name is Brendan Ahern. I am the Chief Investment Officer of KraneShares Exchange Traded Funds. Today, I'm joined with Dr. Xiaolin Chen, our London-based Head of International, and David Adelman, our Managing Director and former U.S. Ambassador to Singapore. As students of China's economy and capital markets, significant changes have occurred over the last 6 months as many economic and investor sentiment headwinds have become tailwinds. We believe China's economy is uniquely positioned on a relative and absolute basis, driven by the new post-zero COVID environment. Please proactively ask questions during the webinar as we hope for a lively Q&A post-presentation. If viewing on KraneShares.com, please email us at info@KraneShares.com. If viewing on Zoom, questions can be asked in the Q&A button, or if joining us on Bright Talk, you can submit via the Questions tab. For those who would like continuing ed credits for the CFP, CIMA, or CPD, please email us at ce@KraneShares.com. Let's dive in. Very quickly, for those of you less familiar about KraneShares, our founder, Jonathan Crane, formed 2 core beliefs during his experience living and building a successful business in China. These 2 beliefs were the basis for founding KraneShares over 5 years ago. First, while new China sectors such as domestic consumption, internet, e-commerce, 5G, semiconductors, clean energy, and healthcare have become the new drivers of China's economic growth, these sectors are still under-allocated in global portfolios. Second, the opening of China's mainland equity markets, the second largest in the world, as well as China's fixed income market, also the second largest in the world, will have a significant effect on investors' portfolios in the years to come as these markets are included into global indices. Most importantly, we endeavor to earn the trust of investors through our balanced perspective on China's economy and capital markets. China's rise in market indices, along with its economy, will necessitate investors have a partner to navigate these developments. KraneShares wants to earn that partnership role with you. We maintain a daily research blog available at chinalastnight.com, which we encourage you to subscribe to in order to keep abreast of new developments. With that, let's dive right in. As you're well aware, we've created a whole suite of exchange-traded funds based on China, as well as what we believe is the second largest trend in the next century, which is the climate. So we have both the China suite as well as the climate suite here within KraneShares. And with that, let's dive into our first quarter review. I'll hand things off to you, Xiaolin.
If I can manage to find that mute button. Good morning and good afternoon to everyone. What a quarter. We have, particularly experienced a lot of events in Q1, macro, fundamental, and that many are, in our asset class in China, that we have experienced a huge sentiment relief in terms of policy, how we have felt, finally the removal of the COVID policy in China that led investors a confidence boost in expectation of consumer spending and leads up into the 3rd month in the quarter of March of the key MPC happening in China. The 2 sessions particularly that gave the investors a high hope on confirmation of the senior leadership will get appointed at the meeting and give clarities or reconfirmations on policy that's impact SOEs, impact corporates, and physical spending, growth target, a lot of events and, positive developments has happened in Q1. Much better in return in numbers. We have seen majority or most of the funds are returned in the positive territory, and with some of the sectors and funds that we listed at KraneShares, particularly a bit of high beta, high growth players like in technology, semiconductors, leaders, found actually returns as outperform the other sectors really from a huge rebound of those catalysts we just discussed as a result in Q1. And if you go to the next page, what we often, we share this page in the past with many of you in many occasions when discuss China as an asset class. This is the watch list we have at KraneShares. I think, Brendan often mentioned many items falls into each of the categories in his Yellen notes on daily basis. But this is at high level of our categories of how we're looking at domestic policies, key events that are impacting domestic policies, and externally, what is the developments impacting corporates, even at a high level of political risks between China and the rest of the world. Just to name a few, we look at some of these items. It's last year, even late in autumn time, or pre the NPC time, some of these items would be very much in the heavily watched list, if we may say, and since then, each of them has progressed on a very constructive way to be on the positive. For instance, the zero COVID policy, we are now well, informed that has been completely removed. The travels in China in and out, the PCR test and all these things are completely removed. People are freely traveling in and out of the country, and you have seen the activity pick up significantly in China as a result of removal of these zero COVID policies. There are a few things that are still ongoing, but it's on the green status. For instance, the ADR delisting is very encouraging to see. The report released by U.S. regulator on their first round of on-site auditing that was happened last year from August until the Thanksgiving time. They have now came back saying now they're very pleased with the access they get given and the whole process of the auditing. So that risk of a potential ADR delisting talk is now become more green. If you look at some of the indicators produced by some of the research house, now that risk is below 50%, even lower on the going down trends, which is very encouraging to see that positive developments. Internet regulations, safely assume last year in this time of last year that the Chinese regulator has announced that we are done of the introduction of internet regulation. They have kept their promise for a year now. We haven't seen any new any new regulation introduced impact the internet companies at all. In fact, we have seen the company has moved on and rectified all the things they need to rectify and move on to develop and progress their business as a whole. Obviously, something is very hard to quantify. Most of them, the items under the geopolitical risk is qualitative than quantitative. We're still on watch of that risk. I believe my colleague David will touch base on a bit of in that area and specific topics that are under geopolitical risks in the following page. But if I may say, as a result on the next page of all these positive developments on policy, on sentiments, on regulations, talks between China and U.S., and potentially China domestically, that is very, very pro-growth tone altogether introduced in Q1. That's all has led the market. One, raise the confidence towards China. Second, reassured of the pro-growth tone, pro-growth policy, pro-growth priority in China. As a result, that we have seen, the streets focus on China's growth, China's inflation, even the valuation are still at very attractive points. And Brendan often loved this table. I know he probably shared with many of you when he meets you that he asks you to cover the country's name and just look at these numbers on, just look at the numbers blindly, just cover the names of the country and see who offers you the most promising GDP growth. That's the third column there with the most attractive valuation right at the end and with the lowest inflation rates that allows the monetary policy to stay very accommodative. If you take all those factors in, that's the countries on very much the first line, that is China. So we stay very optimistic towards China's developments this year, with given all these scenarios of less of inflation requests, high expectation on GDP growth, and very attractive valuations. as a whole. This is obviously a result of all the development we discussed on the previous page, and coupled with the recent announcements, really the policies that give us the confidence that this is very realistic returns or realistic growth potential for China as a country to achieve. And then all of that together, if you move to the next page, that we have seen is China has been able to produce, at least at the earliest stage, I'd call them, because February and March is really the 2 months that China has back on track on, to recover its economy post removal of the zero COVID policy, the full month. February is the month that the post Chinese New Year have a full month, and obviously March is the second month. Obviously, we see PMI, for instance, has really picked up significantly in February. I know March has a slightly dip, but still above 50. It's reconfirming the expansionary status for China's activity as a whole, particularly the new order, new exports order, all those sub-indices in PMI that are showing expansionary, status for China, which stays encouraging to see at the earliest stage of recovery and earliest stage of removal of the zero COVID. And as a result, you see China's consumer confidence. You have seen a significant drop in 2021 towards the end of 2021, and that's marginally pick up in 2022. And now the numbers are picking up, obviously, from a very low level, but it's reflecting the activity that is happening in the underlying economy in China, and also how investors are, value and seeing China as a whole. And all of that I want to put aside is to say, China as a country, as a nation, as a group of people who always famously known that they love savings. I can say this as a proof by seeing how my family save their, incomes as high proportion of their, savings in their overall financial books. This year, we see very interesting statistics on 2022 that China's household, this is a pure bank deposit, this is pure savings in China, has increased to $2.6 trillion. This is 80% increase when you compare a year ago. The rates is really unprecedented level of savings by the Chinese household. That's 80% increase is, I think, is the highest number among developed or developing countries that to achieve. If we use that as a base case to say people have saved up in 2022, and if we use U.S. as probably a guidance to say, once you save up that much, what would you do after the relaxation of COVID? If you look at the little amber or oranging line, that's U.S. saving rates pre-pandemic. And then the little drop at the slope to going down is post the removal of pandemic, that U.S. households start to spend really massively. And then we expect similar trends to happen in China, as you see the huge pickup in savings, and we do expect that to follow the U.S. trends, that to be able to rebound and encourage and fuel the liquidity and cash flows into consumption. If you go to the next page, I just want to share a couple of points on that. This is the 2 session that has happened in China in March. This is very important. This is the first senior leadership get together post the Chinese Communist Party in October, when the Communist Party re-elected their leaders. This is a forum you would expect 2 things. One is who would get appointed as a senior leaderships in China, and who would, and how we could expect policies or economic pro-growth or economic policies directions. You can get expectations or detailed from these 2 sessions. Obviously, a lot of the position reconfirmed at this meeting is very encouraging. The new premier, Li Qiang, get reconfirmed. We have talked about his background in the past webinar. He is a very famously known hands-on person, a person who knows how to work with, private firms. Private firm means state-owned, who also famously known welcoming international investments into China, He grown Shanghai literally to become the fourth largest city in the world, ranked by GDP during the 4 years of him being the boss of Shanghai. He also brought Tesla to Shanghai just in a few months' time, from starting talking to actually launch the factory, start to produce the first Tesla car. So you can see his background is really get it done, very hands-on, get it action, get it move on. So it's very encouraging to see him get appointed. And he gave a first report to the media that confirmed the GDP growth around 5%. And most importantly, we got to note is he's promising to look for a job for 12 million people this year, for the fresh graduates and also the people who re-enter the market. He's very, promising in those. And he also came out in Boao Forum very recently announcing, the SOE reform, the importance of private corporates to come and play and supporting China's economy altogether. Our take on NPC is one, the most pro-market, pro-investor, pro-growth leadership get confirmed their position. So now they can get the job started. Second, the Chinese policymaker has reconfirmed the market. They will stay accommodative on monetary policy, physical spending, and we expect more tax cuts for corporates, more physical local government spending to come. Brendan, I don't know if you have anything to add on this page. I'll pass it to you.
No, I think it's key that, oftentimes China, people say it's not transparent, but in terms of government policies, they're very transparent, and they're literally telling you as an investor what you should be doing. And certainly, I would just highlight that reform of state-owned enterprises is showing up in performance, that state-owned enterprises are actually outperforming on a year-to-date basis as the government really incentivizes these companies to strengthen their balance sheets and productivity. So I think it's just very key that investors are keyed into what these policies are in China. And I think, again, one of our key thesis for this year that was reaffirmed at the dual sessions was the importance of domestic consumption in China. And I think that's something that we've seen on the next slide, that if we think about recent events in China just over the last week, at both the China Development Forum as well as the Boao Forum. The Boao Forum is literally, they call it the Davos of Asia. What types of CEOs were in attendance? Very much foreign multinational CEOs from a whole host of predominantly, I'd say, companies geared to consumption, particularly, domestic consumption in China. And I think this shows us two things. One, it's the Chinese government telling us that China is open for business. Secondarily, they're telling us the importance of domestic consumption based on the speakers that spoke at these events. And you're seeing a whole host of, even today, it's announced that President Macron of France will visit China at the end of this week. The CEO of Airbus is meeting in China this week. And so, I think it's just key that, you have this dialogue and communication as China opens up. And I know David will speak to this, but it's one of the things that does concern us is the lack of communication between the U.S. and China and China to the United States, where a whole host of business people are getting on airplanes and going to China and meeting with one another and talking, communicating, which is so key to success in business. And we're seeing this happen. And on the next slide, this is important for all investors because investors have an implied exposure to China through global multinationals that have done very well in China. And as the political rhetoric between particularly the U.S. and China and vice versa, it potentially has an effect of hurting the balance sheets, the net income statements of companies that have been doing something that the politicians aren't doing, which is getting on airplanes and meeting and talking and having lunch and dinner with one another. We saw that, right? And I think investors globally are far more exposed implicitly to China and China's economy, and particularly against the backdrop to Xiaolin's point about if you think about the relative and absolute outperformance of China's economy this year, that we investors want to be gaining exposure to China. And yet I think many investors, even though we've seen arguably four out of the 5 major headwinds to investor sentiment have gone from red to green, they're held back by one issue, which David, I think has been front and center is the political rhetoric between the U.S. and China. And we can move to the next slide.
Well, thank you very much, Brendan. As Xiaolin discussed the different risk factors, there are both the domestic risks as well as the geopolitical or global risks. And we get questions every day about these issues. And here at KraneShares, we follow this very closely in both Beijing, Washington, European capitals, and of course, here in New York. I just want to briefly cover some of the headlines. First, there were some very highly covered in the media hearings in Washington, D.C. regarding TikTok and ByteDance and what that particular Chinese product might mean with regard to risk in the United States. And this, I think, was the first time we can really see very clearly that U.s. China relations have now entered this era of strategic competition. The evolution really from 2009, 2010 until this year has been one from a gentle engagement practiced by Barack Obama and Hillary Clinton to today, where there is, a full display of direct competition between China and the United States. And on the government side in Washington, that's sort of Biden and his Secretary of State, Tony Blinken. Congress, of course, has a role in this. And the Republican U.S. House of Representatives conducted hearings where, in fact, the ByteDance CEO, Shou Chu, appeared before the U.S. Congress to answer questions about TikTok, this uber popular application in the United States. Here are our takeaways, and we spoke with decision makers in Washington, as well as decision makers across corporate boardrooms in China. Our takeaways are, first, the U.S. government recognizes that TikTok is incredibly popular in the United States, with upwards of 150 million American users. It's, I think, a real testament to China's ability to compete in this world of social media and consumer-based applications. Second, we're seeing for the first time, I think, very explicitly, U.S. companies, you can pick the ones pretty easily, Google, Facebook, Twitter, and the like, who are actively lobbying in Washington, D.C. to try to limit a Chinese company's penetration in American markets, and doing so, frankly, with very mixed results. There is a recognition in the hallways of Congress that TikTok, this ByteDance product, has become increasingly important to the American economy, with small businesses relying on TikTok for purposes of advertising and the like. And of course, especially the very valuable 18 to 34-year-old demographic in the United States, who are very heavy users of TikTok. In other words, a ban on TikTok in the United States would be very unpopular, and members of Congress in Washington, even those who position themselves as the most hawkish with regard to China, have come to a recognition that a ban is not going to be practical, but rather they're going likely, we think, to pursue some sort of divestiture or divestment requirement, which in fact would put in place safeguards to safeguard American consumers' private information from servers or from storage in China. You heard Shou Chu, TikTok's CEO, argue in support of the so-called Texas plan, which, by the way, is favored by the American competitors as the right way to protect consumer information. And I think the Biden administration and leaders in Congress are going to have to grapple with that as they consider potential divestment or structural safeguards for purposes of protecting those investments. A second big event this quarter was the so-called balloon incident. And if any of you need to be reminded, this is an episode where a very large, high altitude balloon, a Chinese balloon entered U.S. or entered, I should say more accurately, North American airspace in late January and January 28th. And between January 28th and February 4th, traversed North America before finally being shot down by U.S. Air Force military aircraft on February 4th. And we're viewing this episode by stepping back and considering it in more full context. To us, the important part of the story is that prior to this high altitude balloon entering North American airspace, U.S. Secretary of State Antony Blinken, was preparing to travel to Beijing for what would have been the first truly high-level meeting between the top U.S. diplomat and top U.S. diplomat and top Chinese diplomat in China in approximately 6 years. He was scheduled to meet with Wang Yi, considered to be China's top diplomat. Because of the confusion associated with the balloon entering North American airspace, unfortunately, that meeting was canceled or, I suppose, rescheduled. And we viewed that as definitely a setback for U.S. China relations. But nonetheless, we were encouraged that only a few days after the balloon was removed from the sky, Blinken did, in fact, meet with China's Wang Yi on the margins of the Munich Security Summit. There were definitely tough words exchanged in that meeting, but interestingly, the tough words really weren't about the balloon. The tough words were about China, Russia, and the Ukraine war. As a reminder, this is where the United States admonished China to not provide lethal weapons to Russia that could ultimately find their way to the battle in eastern Ukraine or in Ukraine. And to date, there's been no evidence that there have been any sort of sale of lethal weapons from China to Russia that have turned up on the battlefield. We probably haven't heard the last word on the balloon, and China continues to maintain the position that the balloon was nothing more than weather-related instruments. The U.S. believes it had sort of intelligence gathering capability. But even the most hawkish American government officials acknowledged that the type of intelligence gathering capability that could be on board this high altitude balloon could easily, that type of information could easily be ascertained through other means that the U.S. and China regularly engage for purposes of intelligence gathering. So the bottom line is the balloon, we think, will fade from the public discussion. And we expect diplomatic talks to pick up this quarter and into the summer as the parties continue to the U.S. and China continue to recognize for there to be effective strategic competition, there needs to be this communication, increased government-to-government communication that Brendan referred to a few minutes ago. The third sort of headline issue, I think, in U.S. China relations continues to be cross-strait relations and how the two capitals are going to continue to talk about and continue to behave with regard to Taiwan relations. And just as a reminder, this is not a new issue. This is an issue, frankly, that dates back to 1979. The recognition by the United States of the People's Republic of China, the passage of the Taiwan Relations Act of 1979, and the status quo has been this strategic ambiguity, if you will, whereby the United States recognizes Taipei and recognizes Beijing and continues to maintain a balance that historically has been acceptable to both Beijing and to Washington. And we think that will continue, despite some of the heavy rhetoric and even a flashpoint last year when U.S. Speaker of the U.S. House of Representatives, Nancy Pelosi, visited Taipei. We think we are returning to a normalization or a continuation of the status quo and the strategic ambiguity that has served both Washington and Beijing quite well. And this historical context, I think demands a reminder that Taiwanese politics are a big part of the ebb and flow of cross-strait relations. And the people of Taiwan have, I suppose, a habit of voting for change. And the two major parties, the KMT and the DPP, over the course of time, continue to be part of a revolving door, if you will, in the leadership of Taiwan. And we expect that to continue. In fact, the current governing party suffered losses in local elections last year. There's a national election coming up late this year. The president of Taiwan, Madam Tsai, will be term limited. So even if her party were to prevail in what could only be a very close election, she won't be the leader of Taiwan. We can expect new leadership in Taiwan. And maybe, in fact, her party will be turned out if the trend holds. We are not surprised that she is coming to Washington. That is typically what a leader of Taiwan does in their last year in office. And we expect there to be some continued hot rhetoric as members of the new U.S. Congress decide they want to see their names in the headlines and they want to visit Taiwan, perhaps even the new Speaker of the House, Kevin McCarthy. We don't think that's going to create the type of kerfuffle Pelosi's visit created, in part because Beijing understands that there's nothing Democratic President Joe Biden can do to influence what the Republican Speaker of the House, the leader of the opposition, does with regard to headline-grabbing visits around the world. Perhaps the most important takeaway from cross-strait relations, in addition to what we think will be the continuation of the strategic ambiguity, is the increased trade flows and capital flows across the straits. And we put the logo of Foxconn up there because it's such an easy example. But to be clear, it's just an example. If Taiwan were to be treated separately for purposes of statistics, it would be by far the largest investor in China, and the capital flows go in both directions. Most people, I think, participating in this webinar probably have an iPhone right in front of them on their desk or in their coat pocket. Make no mistake, that iPhone was most likely assembled in mainland China by a Taiwanese firm and flown, famously in those large cargo outfitted jets to the United States, and finally shipped to your home or to your nearby Apple store for pickup. That's a story that has been uninterrupted. Will continue. It's a story and a phenomenon that is in both the interest of Taiwan and Beijing, and it is in the interest of Europe and the United States and global consumers. Finally, just as we move to the last slide I'll cover, and in the interest of time, I'll move very quickly. Both Brendan and Xiaolin talked about these broader risk factors, and I just want to sort of focus on a few of those international risk factors. First, China has, for the first time, emerged, I think, as a global diplomat. We have seen President Xi Jinping engage with Russia in promoting some solution to the war in Ukraine. That's new, and that's significant. It shows that President Xi and the PRC recognize the importance of global stability and strength of the global economy as they take Chinese companies global and as they continue to be this strategic competitor of the West and become increasingly integrated in global capital markets and the global exchange of goods. So while many geopolitical commentators have noted that China is sitting pretty, as one of them put not that long ago, with regard to Russia because of the access China continues to have to Russian energy supplies, and it shouldn't be lost on anyone that in the Xi-Putin meeting, there was really only one deliverable, and that is the contract for construction of a new natural gas pipeline providing energy resources from Russia to China. The fact that President Xi is trying to engage in the peace process is significant, especially because the other sort of leading country in the world, the United States, is not really in a position to engage in that type of diplomacy because it has taken the lead on imposing very challenging sanctions on Russia. The second place where President Xi has emerged as a diplomat, of course, is with regard to Saudi and Iran. These are heretofore arch enemies, but both of which have in common the fact that they are big suppliers of energy resources, in this case, oil, to China to power China's growing economy. President Xi saw that there was a role for China to play to insist that those countries reopen embassies in each other's countries and to begin to normalize some diplomacy. We continue to watch China's emergence on the global stage in diplomacy because we think it is driven by China's desire to continue to go global with its companies and to further integrate into the global economy. Second, I want to briefly mention that U.S. Treasury Secretary Janet Yellen has been very clear and very open about her desire to visit China as soon as possible. The National Security Council spokesman recently confirmed from the podium the importance of Yellen visiting China, recognition of China's importance to the American economy, and we expect that visit to happen likely in this quarter. Despite all of the headlines, cross-strait tensions, balloons, hearings on Capitol Hill about social media applications, two-way trade between the United States and China has increased over this quarter and increased dramatically. Capital flows are also up. But the maintenance of this, very high level of the exchange of goods, we think augurs very well for a continued reduction in the U.s. China risk factors. At the end of the day, for diplomats, the ideal posture for two countries to be in is for them to have a stake in each other's success. And the reason we view the risk factors this quarter as being trending favorable is because we believe that China continues to have an interest in American economic success, and the United States continues to have an interest in Chinese economic success. And that those fundamental facts, we think, set the stage for this era of strategic cooperation to be one where that cooperation benefits both economies and ultimately results in increased global growth. I've said a lot, and I know there'll be a lot of questions. Thank you. And I think, as Brendan has said, please submit your questions in the Zoom chat or email them to us, and we look forward to answering them during this webinar, or perhaps following up with you after the conclusion of the webinar.
Thank you so much, David. I think, it's very important for us to quantify, qualify as much as we can on the geopolitical risks to the certainties we can. But I just also want to draw the investors, or all of you who delve into the call today, is to the attention of China itself, domestically itself, would be also sufficient to grow its economy, just for a very simple fact that China is a very uniquely positioned a country who has the highest number of middle class, highest number of people who live in the city, highest of numbers who have the strongest, savings in the world, and potentially the big, consumption power to recover, to rebound or support the rebound of the economy. And then a lot of the positive development we have seen post the NPC is very proactively state-owned enterprise to reform, to become more efficient, more efficiently managed, to compete with private firms. And also the private firm, remember we mentioned earlier on, that are completing, particularly the internet companies are completing their internet regulation. They moved on. And when we say they moved on, is, for instance, Alibaba bought a new, a food delivery platform called Adelman. Are you hungry? A food delivery to complement what they have been missing as a piece of puzzle in their overall business, to say, I have the best logistic in the country. If I could couple with something people orders now on more often basis, we could grow that business. That unit's become very profitable as one of the business in Alibaba. And for very recent, you probably see the news from Brendan's China Last Night notes. We have covered this in details, is the announcement by Alibaba of the splits of their business into 6 different units. I think you read the news, you see the headline news, you read Brendan's notes, but simply put, why are they doing this? Is now they say, look, our business is so broad, so diversified. Each line of the business are actually developing at a different stage. Some maybe are very much at stage 1, need a bit of a consolidation, reorganization, make it more efficient, let it be. And some of the units of our company is very matured. We're looking for funding. Therefore, our business is very strong. We look for sufficient funding to fuel us to the stage 3 of potential public listing, to allow investors to access to that unit as individual listing. And some of them are very much ready to be listed. All of those are to differentiate different line of business happening in Alibaba, big company like Alibaba, and also to differentiate and the different stage of developments in each of different areas. For instance, some of the technology development happening in Alibaba and other business or other companies of their line business actually very advanced. They probably, not to be fair, to be penalized by the cap of their company, parents companies' ratings as a whole. So we think this is very positive developments. It actually will create more better shareholder value for our shareholders in those companies. Now, this JD follow the same footstep to doing that. We expect to see more of those developments happening or coming out from China. But that is just a beginning, in our opinion, is a beginning of a many to come, to show that the Chinese, one, domestically, they can grow their economy. Second, they are ready now to develop to the next stage of all these big companies, to differentiate, to highly emphasize the needs and developments of technology, of logistics, of online, of retail, of financial tech, fintech companies, to create a different line of revenue. As a result, you may see other players come into those industries and sectors as a new player that creates more healthy competitions, more developments along those lines. If I may go to the next page, I really want to draw your attention to this page particularly. We use them very often. We agree that Brendan uses it, I use it, I think David uses it. We all use it for a very simple reason of our KVAP fund has captured majority of the names that are most beneficial and capturing a holistic rebound of China's consumer power happening in China. And they are representative of the true growth engine happening in China as GDP continues to grow. If you look at this chart, the purple line, purple bar, is actually the quarter-over-quarter of earnings produced by the top 10 companies in KWEB fund. And the blue line is the KWEB fund performance itself. At the very beginning of the history, the earnings produced each quarter, the fund performs in line. If there's a dip on earning, there's a dip in performance. If the rebound, it very much trended in the same direction until this internet regulations happened. That you start to see the disconnect, okay? Despite the companies, yes, corrected in their earnings revenues, but they go back to their own pace. They continue to produce solid earnings over quarter. But the fund performance of KWEB going to another directions. But now we are comfortably to know and confirmed the internet regulation is behind us. Zero COVID is behind us. Government has been pro-growth policy, pro the private company, pro-internet company to deliver jobs, to become competitive again. And that blue line is to rebound, to recapture the strong fundamental earnings for all these companies has been produced in the past quarter and continue to produce in the coming quarter. Obviously, you have seen a bit of uptick in the recent month and quarter to reflect the positive development in the market, but still there's a huge gap to capture in those instances. And remember the valuation where the companies, where the funds are today valued at, and the huge potential and the huge surprise on the upside for KWEB to continue to progress in the quarters to come. And lastly, I want to leave you on the page, on the next page is we touch base on the ADR, we touch base on how investors are seeing or allocating to these names that are in our KWEB fund. One thing I want to highlight is because of some of the issues or some of the concerns on potential ADR delisting talks that actually forced in a good way for the companies to look for alternatives. What I meant by that is, for instance, Alibaba is purely listed on New York. Investors in mainland who actually contributing to Alibaba's success day-on-day basis, they won't be able to buy their stocks. But now because of the ADR talk, Alibaba listed back to Hong Kong, and then the mainland investor who contribute the growth to the company are now be able to buy their stocks as a result. And we use Tencent as an example here to just show you how the mainland Chinese investors are allocating to Tencent, the company listed in Hong Kong, as a result of such availabilities to these stocks. And obviously, I think, Brendan, you often like to mention Bleepy. Do you want to touch base on that, Brendan?
Yeah, it's an online video company very much geared to online gaming, the proverbial Twitch of China, where kids actually watch other kids playing video games. It makes you feel old, but I think the key is that Bilibili was recently added to Southbound Stock Connect, and like certainly following in the footsteps of a company like Tencent, who has a significant component of its aggregate ownership held by investors in mainland China, and we would anticipate Bilibili also to see a significant uptake. So real positive for the company, and certainly something that we anticipate for other dual listed names in Hong Kong.
Very good. Next page, Brendan, is our KWEB page. Obviously, this is U.S. and UCIS, and we just summarize a little cheat sheets for you to highlight what is the investment strategy that KWEB fund is trying to capture for investor in investing in this fund. I think many of you delve into our webinar on a frequent basis. This fund is a flagship ETF. It is a symbolic ETF. We're very proud of the track record over 10 years for this fund now, and for how this fund actually offer you the true growth engine. All these names are very representative of the new China theme play. I'll pause there, Brendan. Do you want to add a few words and before we take to the next theme?
Yeah, I think certainly we're very constructive on KWEB. We certainly had we've had a nice performance run from the Party Congress up until end of January, and I know the balloon gets a lot of attention. But at the same time, end of January was when the U.S. dollar got very strong. and made really, I'd say February as well as March challenging for risk assets globally, including KWEB. And so I think one of the keys that investors need to watch is just if we get a little bit of an end of this hiking interest rate hiking environment in the U.S., it's very likely we could see a weak dollar, which would be another great tailwind for KWEB. And I think that's something that, due to the financial, the banking crisis here in the U.S., the potential for a debt ceiling crisis here in the U.S., that it's potentially we'll see at least a slowing of the Federal Reserve's hiking, and I think that's a great catalyst for KWEB. As much as the balloon gets a lot of attention in terms of the weakness we've seen, I think ultimately you had a very strong performance run by KWEB. You get a little bit of a pullback, and I think we're starting to see a resumption of that uptrend. Knock on wood, as a shareholder. So I think again, the dollar. If we could see the dollar taper off a little bit, it could be a real positive. I think part of our thesis has been, we kind of jokingly call it on the next slide, the pain trade is higher. That one of the questions, and please reach out via the Q&A button or emailing us at info@KraneShares.com. One of the first questions we got was actually, why is there this hesitation? Despite many of the catalysts, many of the positives that we've seen, many investors have been underweight China. And what's interesting, based on some great analysis from the Asia research team at Morgan Stanley, is that we have seen investors underweight China, but that underweight, as we mentioned, our dashboard, 4 out of the 5 turning green from red. Many professional investors outside of the United States have been reducing that underweight to China. What's interesting is that U.S. investors, professional investors within the United States, have maintained that underweight to China, and that's, I think, really to the geopolitical situation, which many people just believe that an invasion of Taiwan is inevitable. I just, to David's points, we just are not believers in that thesis. And these investors, think about the strong performance we've seen in KWEB. If we get this continued resumption, if we see the shareholder-friendly moves by Alibaba and JD.com, Tencent, today, we highlighted in today's China last night, Tencent bought another 900,000 shares today. It's the 7th day in a row. And, I think there's just a lot of U.S. investors are just really, this Western media narrative of, negativity. They've really missed out on some of the strong returns that we've seen over the last several months, and we anticipate can play out across 2023. And remember, this underweight to China, that quickly becomes tracking error. It quickly becomes negative alpha, which gets you fired. And so, again, part of our thesis is the pain trade is higher because of this under allocation, which is a uniquely American trait. It's not something that we see outside of the United States. Now, on the next slide, one of the things we've recommended to investors is that we often gravitate to the companies within KWEB because we can really understand how a Baidu search function is very similar to a Google, or the similarities between, say, an Amazon and an Alibaba. But I think, we kind of characterize KWEB as the offshore market because that market is predominantly held by investors outside of China. So it's almost more of what do foreign investors think about it. And I think, it's important that we also have exposure to the onshore market. So the Shanghai and Shenzhen stock exchanges, those underlying stocks that you hold within KBA and KA50, our UCITS counterpart, 90+% of that ownership is from investors in China. So it's more reflective. What do the Chinese think about China? And And one of the reasons why we're constructive on the KBA, the KA50, our onshore China thesis, is very simply something that I think a lot of us are thinking about. That here in the U.S. on a money market fund, you're getting almost 5%. And so all of a sudden, after years of 0% interest rates in your bank account or in a money market fund, all of a sudden, equities have a real competitor, which is the risk-free rate. Earning 5%, taking no risk is a pretty good deal. And that will be a headwind in some ways to U.S. equities. And in mainland China, we have a very different situation, that this is the world's most simplistic market timing model, where we simply take KBA's dividend yield and divide it by the yield of a 10-year treasury bond in China. And so what this is really saying is, how competitive are stocks to bonds? And I think there's an argument why in the U.S., why equities have a competitor in U.S. equities. Quite candidly, I recently put money into a money market fund instead of buying stocks, because 5% looks pretty good. But in mainland China, you have a very different situation where, because of the easing, the lowering of interest rates in China, stocks look very compelling. And you can see at extremes, this market timing tool has provided a pretty good track record. We're just saying that, stocks and bonds compete with one another. And if you're in mainland China today, stocks look quite compelling. Now, there is another investor who has recognized this. On the next slide, Xiaolin spoke earlier about southbound Stock Connect, the flows into Tencent, as well as Bilibili being added to southbound, but it's a two-way street. And foreign investors, including KraneShares, utilize northbound Stock Connect to gain access to China's onshore equity market, the Shanghai and Shenzhen stocks we hold in KBA and KA50, through the northbound Stock Connect. And what's very interesting is that investors have been buying this market very, very strongly. And we believe, it's hard for us to ascertain, but it's our belief that what's driving this is active managers within emerging markets, Asia ex Japan, or dedicated China strategies, are going overweight these China A shares, the onshore market versus the offshore market. The other thing I'd point out on this slide is, if we looked at what are the stocks these investors are buying, well, 4 of the 10, the number one holding from foreign investors via northbound Stock Connect is Qichua Mutai, the very large liquor company in China, which also happens to be the number one holding of KBA and KA50. And in fact, 4 of the top 10 most widely held names by foreign investors in northbound Stock Connect are actually the top 10 holdings of KBA and KA50, which simply begs the question, why are you paying an active manager to buy the stocks that we can happily buy on your behalf in KBA and KA50? But why I believe many of these professional investors are going overweight onshore China, overweighting the KBA names versus the offshore market, is on the next slide, due to the simply that you've seen this performance between onshore and offshore China really does change. And again, that's been one of our main thesis of why investors want to have access into this onshore market, this very low correlation relative to other global equities. And certainly as investors in this market for over 9 years now, arguably we're one of the more seasoned investors in the space in terms from an experience perspective, but we're big believers in having exposure to this onshore market. And I do think that is true today. On the next slide, very simply because this onshore market, again, is more reflective of what do the Chinese think about China. Now, that's very different from offshore China, which is predominantly held by foreign investors. And so unfortunately, we know that, with potential, the head of the U.S. House of Representatives, Kevin McCarthy, meeting with the Taiwanese president tomorrow. Headlines, are going to be, flashing red, and but it's important to recognize both Hong Kong and mainland China is actually closed tomorrow. But more importantly is that onshore China isn't going to care, because in China, the belief is that China's not going to invade Taiwan. And I think what you're seeing is that, this Western media narrative has weighed a bit on this offshore market relative to the onshore market. And it's not that investors in China don't have access to Western media. They just simply don't believe the headlines. And I would argue you shouldn't either. But again, we can see that KBA, relative to both MSCI China as well as the offshore market, has held up better. Now, many investors will simply buy an MSCI China. But on the next slide, we show that because MSCI has only added a small percentage of Chinese A shares to their indices thus far, that the China A inclusion has not hasn't been increased, that by buying a MSCI China ETF, you're much more exposed to the Western media narrative than if you simply held the way China should be held, in our opinion, which is simply a 50-50 split. That if you actually take the aggregate market cap of onshore China versus offshore China, it's basically 50-50. And that lines up really well to holding 50% KWEB and 50% KBA, or the UCITS equivalent KA50. And in fact, if one simply rebalanced annually, you get a really nice sector diversification between the two. And again, we think that that's very critical. So again, instead of being more exposed to offshore China via MSCI China, a simple 50-50 split holds up really nice, and really it's interesting that offshore China, people say, oh, onshore China, it's individual investors, but onshore China has half the standard deviation today of onshore China. That again, this Western media narrative, unfortunately, has weighed on the space, and just holding the two gives us exposure to both these markets. Now, on the next slide, again, we think there's really so many compelling reasons to be long China today. That if we just went back a few months ago, our dashboard, 5 out of 5 would have been flashing red, and today it's 4 out of 5 are flashing green. Geopolitical concerns certainly have weighed on the offshore market much more than the onshore market. Certainly, we believe some element of the offshore market, the weakness we've seen, is actually driven by the strong dollar, not the balloon. But we think something is happening in China's economy, which is vitally important, which is the China consumer is coming back online. China's economy is going Q1 will be better than Q4. We're seeing that already. Q2 will be better than Q1. We certainly believe this pullback we're seeing is an opportunity to investors to rectify this underweight. And if we simply allow the political headlines to dictate our investment positions, well, we know that many U.S. multinationals are much more exposed to China than we're willing to admit. And that's why we need these dedicated positions to China. And we certainly do look for a very strong year in our belief in terms of China's economy and the stock market. And just couldn't reiterate that more. As well as the market is underestimating the potential for good news, positive black swans. I think that's something that really could happen in terms of a Ukraine settlement, facilitated by China. potentially actual U.S. politicians, Chinese politicians meeting with one another, something that's happening for many European, many global leaders are going to China, and it's about time for U.S. politicians to do the same. And it's time for Chinese political leadership to come to the United States. Let's get through some of our compliance slides and get into some of our Q&A. Again, I think it's always important we provide a free resource to keep abreast of developments in China, our ChinaLastNight.com research blog, but certainly we're always available at info@KraneShares.com. Of course, both China and Hong Kong are closed tomorrow, but we'll be back on Thursday. But I think some of the questions we've gotten thus far, one question that we got for you, David, is in light of your experience, this is a great question, just in light of your experience, the time you spent in Singapore, is what role do you think Singapore can play in allowing for better U.S.-China relations? I know one of my favorite books about China is Graham Allison, and I forget his co-author, their book on Lee Kuan Yew, but really the consigliere of the Chinese leadership. And I know someone you were able to spend some time with Lee Kuan Yew. But can Singapore help amend this frayed situation between the U.S. and China politically?
Yeah, listen, it is a great question, and maybe we should even think, Singapore has a special place as the most trade-dependent economy in the world. There's no country that wants calm waters across the Pacific more than does tiny Singapore. I mentioned that if Taiwan was sort of treated separately, it would be sort of the largest investor in China. Putting Taiwan aside, the largest foreign direct investor in China is tiny Singapore, which surprises many people. And yeah, the short answer is, I think Singapore historically has tried to play that role. They are friend to all, and they have historically tried to play that role of calming the waters across the Pacific. But, maybe a better way to think about Singapore is to think about all of Southeast Asia. Southeast Asia, is a huge place, 800 million people, and increasly integrated through ASEAN and other, type of harmonization type of policies. And they need Beijing and Washington to get along. And I think you'll find increasingly the leaders, whether they be corporate or government, trying to act as active intermediaries between Washington and China. I can tell you that that's what President Biden and President Xi hears, in the whispers in the hallways and on the margins of all of these summits. Wherever they go, they hear Singapore and others in Southeast Asia telling them that there needs to be, some pressure let out of the U.S. China relationship. It has been the last sort of 15 or 20 years focused on the South China Sea, or perhaps on North Korea. But Taiwan has always been, sort of that low level anxiety hanging over the region. And I think the Singaporeans and others in Southeast Asia rightfully take some credit in managing cross-strait relations and increasingly trans-Pacific relations. They have a very strong economic stake in calm waters across the Pacific. And I think they would rank it as their highest diplomatic priority. It was the fun part of being the U.S. ambassador in Singapore. Singapore is a very important place, and bilateral relations between the U.S. and Singapore are, of course, very important. But what makes the job special is the role Singapore has in trans-Pacific relations in Beijing and Washington matters.
Yeah, and certainly, when you visit Singapore, you stare out at the Strait of Malacca and just see super tanker after super tanker after super tanker, on its way from the Middle East to China.
Yeah, these are the busiest shipping lanes in the world by far. Singapore is the largest transshipment port in the world. Shanghai is, I suppose, the largest container port in the world, but Singapore is the largest transshipment container port in the world. And nobody has a greater stake in this strategic competition. And candidly, Southeast Asia is in a very good place to be a beneficiary of this strategic competition.
An interesting question, Xiaolin. So one question we have is, and actually, before I should say, if you would like a copy of the presentation, we're happy to provide it. If you just email us at info@KraneShares.com, we'll get it off to you post haste. But the question here is that do we foresee any risk to H-share listings on the Hong Kong stock exchange, given the China's integration of Hong Kong under the mainland regulatory framework?
I think the influence is actually on the positive side. I think March or February when Hong Kong amended some listing rules. It was very much in line with what the mainland board are amending their listing rules as a result. And Hong Kong is amending their listing rules as a result to incorporate the changes happening on main board. I do think both markets actually learning from each other. The Connect is the example, stock or ETF is one. International investors still using Hong Kong as a key entry points to China as a very flexible entry points. I do think Hong Kong continue to serve as a very important point for China as a intermediary between mainland and international investors. I wouldn't pose it as certain risks. Actually would be helping on both sides to become more accommodative to international investors' request, and also for mainland board to become more updated in many ways. Now that IPOs is the system-based, is more updated, more modernized. They're going to introduce more, I say now it's voluntarily, but more compulsory of ESG policies. Yeah, that's all thanks to the connect happening. The international investors are investing in mainland. Those developments are all on the positive side, I would say, Brendan.
Yeah, it's interesting just because, even when we're talking about the Alibaba restructuring, something we've seen from JD.com is that spinoff will happen in Hong Kong, and I think a few years ago that spinoff would have taken place here in the United States. So it's unfortunately, one of the negative consequences of the political rhetoric is, the U.S. exchanges, U.S. Wall Street firms losing out to their Hong Kong equivalents. And I know our friend Sheldon, who spent a lot of time in Hong Kong, like yourself, David. I think he would argue, China has a lot to learn from Hong Kong. That Hong Kong's regulatory body, the CFC, it's a very strict regulator, very well respected, and if anything, China will benefit from the knowledge of how really developed the Hong Kong regulatory market is, and to, I think, exactly to your point, Xiaolin, we've got a lot of positives in terms of that dialogue. We'll take one quick question. The restriction of money flows. So really quickly, Mark Mobus got interviewed about how he couldn't get his money out of China. He was talking about a bank account in China. He wasn't talking about his investment dollars. Over the course of our 9 years of investing in mainland China equities and fixed income, we've never had an issue getting money out of China. Certainly the Stock Connect program only makes that even easier. And so I think Mobus's comments were taken a little bit out of context. He was talking about a bank account, which I don't even think foreign nationals are supposed to own a bank account in mainland China. I'm not, I don't think that. So, he was not talking about investment dollars. It was about a banking and so a totally different situation. I know if unfortunately we've got some conflicts coming up, so we're going to have to wrap things up. But if you have further questions, you wake up tomorrow, the next day, whenever, please always reach out at info@KraneShares.com. Self-serving and highly biased. We love it if you'd sign up for China Last Night to keep up to abreast of developments in China. And most importantly, based on Xiaolin, David, and I certainly appreciate this opportunity. We'll come back in a few months. Again, I'm going to knock on wood as being someone heavily invested in KraneShares ETFs, both KWEB and KBA and several others. I'm hoping that our outlook comes to fruition, because certainly we'll be sitting a little bit better from a personal financial perspective, and certainly I know all of us are hoping that this thesis comes to fruition across 2023 and beyond. Thank you so much for attending today's session. Looking forward to reconnecting in the future.
Thank you so much.
I know.